that the players in the commercial market are going to be more sophisticated, and for the most part they are. But what you have in a lot of instances are folks that maybe are operating businesses, like a good example would be like a restaurant, okay, just as an example. And that restaurant owner may know everything there is to know about operating the most awesome restaurant imaginable, okay? But they don't really, I mean, they're not commercial real estate experts, okay? They don't understand maybe what kind of a deal they're really maybe getting with this commercial real estate loan and what all the caveats are to it, and you know, and so you have a lot of players out there in the market that, you know, while they may be doing very well on the business side, they may still not really fully understand the implications of the deal structure they may get themselves involved with a commercial loan. Okay, just so I just want to kind of put that out there. And if you remember what I said earlier, always think of lenders as retailers, even on the commercial side. I mean, it's certainly the case on the residential side, but even on the commercial side, because here's what can happen. And I've seen this over and over, and I've been a part of it myself. Whenever you start borrowing, you know, you go to one commercial bank to potentially get a loan for one property that you may own, and you go through submitting all of your tax forms and all their budgets and all of this information to, you know, potentially get this loan done and approved, and you've gotten yourself maybe a very favorable rate and terms on this particular loan, your inclination is to do what? Probably go back to that same lender again for the next loan. Well, that next loan, they may sort of kind of know they've got you, in the sense that you've already got that first loan that maybe they gave you a good deal on, but that second loan, maybe not so much, because they're, you know, they know that from your perspective, you're saying, I've already worked with this lender, they've got all my paperwork, I don't really have to go through all this sort of stuff all over again, so maybe we can jack up the rate a little bit, or we can change the terms a little bit, or we can, you know, do something, you know, to potentially not make it as favorable. And I'm just trying to get you to think about it, in other words, so that you don't get yourself into a situation of where you get so comfortable, I guess the right word is, with the same lender, unless you're really paying attention and really watching what the deal structure, you know, might be. Now, that having been said, you know, what are the things that you need to be sort of looking at? Well, I said that obviously the stated interest rate is the first thing. The second thing are prepayment provisions. Third would be loan origination fees. And the fourth would be sort of ongoing or administrative fees. All of those impact your cost of borrowing, okay? And this is where we're going to place a lot of attention, is looking at the stated interest rate, looking at the prepayment provisions, looking at the loan origination fees, and looking at the administrative fees, and how all of those impact your actual cost of borrowing. Now, are there other provisions that are equally or more important? Absolutely, okay? One, and we're going to explain all of these, but I'm just going to kind of sort of go through this. One thing we're going to look at is cross-collateralization. Okay, talk a little bit about that. Then we're also going to look at sort of reporting requirements from the lender. Also going to look at reserve requirements. and a handful of other things. Okay, but let's just start with this. This is a good list to kind of get us going. All right, and kind of explain all of these. Okay, the state interest rate, that one's simple. That's the one that, once again, is front and center, that, you know, your lender says, okay, I'm going to give you a 6% loan. Boom, done, okay? Now, with that stated interest rate, you know, we're also going to probably have, well, what is the term of the loan? And also, what is the amortization period of the loan? Okay, and there's a difference. As I mentioned earlier, most commercial loans historically have had 5-year terms, but the amortization period of the loan, in other words, how the payment is calculated, is typically maybe over 15 years, 20 years. In some cases, you might be able to get it up to 25 or 30 years. You know, standard has been probably 15-year amortization, but a 5-year term. Okay, does everybody understand the difference between that, between those two, between term and amortization? Yes? Okay. Now, what may actually occur is at the end of that if we have a, let's just kind of give a hypothetical here for a second. Let's say we have a 5-year term, 15-year amortization. Okay, so what that means is at the end of 5 years, your loan becomes due and payable, or you've got to refinance. Does that make sense? And what that means is also, when I say due and payable, it means that technically you still got 10 years worth of payments to continue to make, I mean, in one sense, or you've only paid off 5 years off of the value of the loan because it's a 15-year loan, okay, or 15-year amortization period. So at the end of that 5 years, you're typically going to have what is called a balloon payment, okay, meaning that you've got a couple of choices. One is you pay off the balance of the loan or the balloon payment, or you refinance the loan at the current prevailing interest rate and for another 5 years. So you technically are going to have to refinance this loan twice over the holding period, okay? Finance it once for 5 years, finance it again, or refinance it again after 10 years, and then ultimately have it paid off at the end of basically the 15 years.
Do they require you to do it with them?
No. Most of the time you will have the option of getting a totally different lender, but you have to go through the whole process all over again of probably getting a new appraisal. And this is also kind of an interesting thing. Some of the commercial lenders, this is just the kind of the renewal can be almost just nothing more than checking a few boxes and a signature, and it's just done. Other lenders will potentially make you go through the whole process of getting a new appraisal on the property, taking another look at your current and expected leases, taking a look at, once again, your operating history. It's kind of almost like starting from ground zero all over again. And then potentially, as a result of all of that, you're also going to have to pay more new loan origination fees. Okay? So, yeah, there's some real issues. But one of the other things that can happen is that, well, what if within that first 5 years, or the second 5 years, or the third 5 years, because you usually don't end up selling a property precisely when your loan comes due. Almost very seldom does that happen where you're able to sell it precisely when the loan has come due. Meaning that you're usually going to sell it slightly before maybe the end of the 5 years, or maybe even 3 years or 2 years into the loan, based upon what current market conditions might be. That if the current market conditions are very favorable, now is the time to sell, then you're going to want to sell it now, correct? But what may make you rethink that decision a little bit? Prepayments. Every lender is different. That's another thing to sort of keep in mind. Remember I said, think your lenders as retailers? Also think every lender is different. No two are identical in terms of what they're going to offer you and the way the deal is going to be structured, okay? There are some commonalities, but there's an awful lot of wiggle room for them to make adjustments to the loan that may not be in your favor, okay? And so part of what we're trying to do is to kind of illuminate some of those things. Prepayment provisions, the standard normal kind of prepayment provision would be something like 2 or 3% of the outstanding mortgage balance you would have to pay as a penalty for paying off the loan early. Now, why would you be subjected to that prepayment penalty? Why is the lender charging you that prepayment penalty? Because they're losing out on those additional potentially months or years of interest income, and so they're trying to recapture some of that. Because they've made an investment maybe up front with regard to the loan origination, time and effort, even though they charged you for that, but they also want to potentially charge you in the event that you pay off the loan early. Now, some lenders go to a much greater extreme with regard to these prepayment penalties. One example would be in the commercial mortgage-backed securities arena. There, you have these loans that have been made that have bonds that are effectively backing these loans, and you've got these investors that are very rigid in their beliefs about what the cash flows need to be and want to maintain those cash flows that they are expected to get. And so in the event that you pay off a loan early, as a matter of fact, you may actually be precluded from paying off the loan early, but in the event that you still try to pay it off early, then you will be hit with something called defeasance, or effectively this whole business of where they will calculate all of the lost revenue that they would potentially have received over the life of that loan that they have made you, and have you pay all of that money up front. And in some cases, depending on how exacting that may be, and, well, let me back up, not just have you pay that lost interest, but have you pay a penalty on top of that for their trouble of having to reconfigure all of this. And so that penalty could be, and I have seen them, up to 25 to 30% of the outstanding loan balance in some instances, okay? And so you have these folks that maybe have bought a property with investment-backed expectations of, owning this property for a couple of years, and they're out there searching for the lowest possible stated interest rate. The one that they typically get suckered into, and I use that word maybe a little bit loosely, but the one that they tend to gravitate toward, let's put it that way, is typically these loans that are going to be commercial mortgage-backed securities. And with those, there's nothing inherently bad about these loans, except you get to play by their rules. And their rules tend to be a bit more draconian than the normal sort of lender might be, okay? And we're going to kind of get into some of those, but just kind of be aware that those prepayment penalties can take on a very ominous tone that, whenever you're in the market to try to sell your property and you're at the peak of the market, and then all of a sudden you're told, well, we're going to be hit with maybe 15 to 20% of additional penalties, all of a sudden that wipes away any sort of return that you might have gotten on that property. Does that make sense? Okay, so we need to be aware of that. Okay, on the front end, the loan origination fees. Okay, technically, these fees are meant to compensate the lender for all of their sort of due diligence, all their paperwork creation, getting everything done and processing the loan and underwriting the loan and all of that sort of stuff, kind of wrapped up into these fees. Some lenders, once again, it's a very standard, normal, couple of percent of the loan amount to cover all of that. Once again, other lenders, much more dramatic, just, once again, depends on the lender, okay? Administrative fees, these are always really kind of fun because they can be almost anything, but it's that kind of, what many of us would sort of say is that service charge that you sometimes wonder, what is this for? But it's something that the lender can kind of, to a certain extent, sneak in there and say, well, we're going to charge you a payment processing fee. You know, which basically means we're going to charge you money to collect your check, deposit your check, and remit it to whoever the investor is that maybe is investing in the CMBS or, you know, whatever, and we make that fee could be, you know, something relatively small, you know, like $50 a month or something like that, but on a smaller loan that could be significant, you know, but yet on a much larger loan, you know, there could be all sorts of other kind of administrative charges that they want to sort of roll in there. The point being is we need to be aware of that. We're going to do the calculations to sort of show all of that. Okay. Any questions on those? Okay, those are all very quantitative.
Do they pay somebody to make up these fees?
Absolutely. No, I mean, you seriously. I mean, the point being is, lenders, you know, historically have always, and I'm not trying to paint them in a bad light at all. Lenders historically have always, you know, tried to think of creative ways to effectively generate more income for their institution. And like I said, it's why you think of them as retailers. You know, the moment you start thinking of them as retailers, it all begins to make sense, because what, you know, once again, what do retailers do? It's that, you know, I don't want to be overly dramatic, but, you know, say it's all bait and switch and this and that, you know, but the reality of it is that, you know, a retailer will get you in the store with a product that's on sale, and then the expectation is you're going to spend money on other things. Same sort of thing with lenders, that they kind of get you in the door with this, oh my gosh, this is a low interest rate, this looks like a great term, but then all of a sudden they start putting these provisions saying, well, you can't pay this loan off early, because if you do, well, there's going to be a penalty assessed to it. They kind of downplay that aspect of it. Or they start talking about some of these other things that may be problematic, like for example, saying, okay, we're going to require you to cross-collateralize this loan. And what that means is other assets that you may own, we're going to ask you to pledge those as collateral to this particular loan. So that if you own 3 or 4 other buildings, maybe outright, or maybe they have even loans associated with them, that they might ask you to place them as collateral for this loan that you're getting. Does that make sense? Mm-hmm. Okay? And so that in the event that this loan blows up and they have to effectively foreclose and so forth, that they can look to those other properties to get satisfaction for their payment.
Ask you a quick question.
Yep.
Does that, when you do that, does that just make a second mortgage on that existing property?
Potentially, yes. And the part of it is, I mean, it's going to be there's going to be some sort of a lien that's going to be attached to that would ultimately identify that, yeah, it's tied to this other loan. Yep.
Non-recourse loans, are those still hard?
Perfect. Okay, you read my mind. Okay, so typically we have what are called recourse versus non-recourse lending. And this is kind of where this cross-collateralization kind of falls into place. A traditional non-recourse loan means that this property that you're getting a loan on stands on its own. In other words, if it fails, the lender has no recourse to look toward any other assets that you may have, any other property that you may own. This particular property stands on its own 2 feet, and if it fails, and the lender has to suffer whatever consequences associated with that default. Recourse lending, and cross-collateralization is kind of a form, if you will, of recourse, means that the lender can search out and require you to pledge other assets to cover the loan in the event that it does blow up and go bad, okay? And so the type of recourse that most property owners are willing to engage in would be a limited amount of recourse, typically through cross-collateralization of saying, okay, look, I've got this other building over here that maybe doesn't have any debt on it. I'm going to pledge it as collateral so that in the event that this one blows up, then you can potentially take that one. Now, as an investor, developer, you don't want to do that unless you have to, okay? If you are obviously a significant player in the market, that's something that can be negotiated. But if you're not, then you may be, you know, obviously sort of dragged down and subject to that. Now, the most sort of extreme course of kind of recourse is when the lender would require you to pledge all of your personal assets, not just one or two properties, but basically saying, well, we're going to require you to pledge everything you own, type of thing. And very seldom do investors go that far.
Do the properties that you have to do cross-collateralization with, do they have to be in the same value?
No, it's not so much, it's more of, they need to be of sufficient value that the lender could sell them and then obviously be able to pay off the deficit that may.
They usually have to cover. They have to cover.
Yes, yep. And now it can also work in your favor. There's another aspect of cross-collateralization, that if all of these loans are with the same lender, cross-collateralization can work in your favor because it can lower your overall interest rate. Because it's kind of like, a perfect case in point, several years ago, there was a NBA player that owned a bunch of Burger Kings. And basically he had all of the Burger Kings cross-collateralized so that basically if one wasn't doing well and it fell, then the lender could look to any one of the other performing Burger Kings to potentially satisfy the debt. But the concept is just simply one of where the lender has something to attach to, and
it makes it less risky.
It makes it less risky for the lender, and that's sort of my point with this is, it will lower your interest rate as a general rule to have something cross-collateralized with the lender, because the lender is saying it's less risky for them, but yet you are inherently taking on more risk in the sense that you could lose, or certainly lose a portion of those additional assets in the event of a default. Does that make sense?
Yes, it does.
Okay, Dustin?
Can you cross-collateralize, like if you have residential and you're buying commercial?
As long as it's not your personal residence.
Okay.
Your personal residence, it gets all funky because, homestead and all those sorts of things. But as far as like other like residential rental property, yes. Okay. Reporting requirements. This is one of my favorites. Okay, this is, historically, a lender, whenever you would go and get a commercial loan, or even a residential loan for that matter, but just a commercial loan, the requirements were you make your monthly payments, and over the course of the loan, you never talk to the lender, they never talk to you, you never give them anything. It's just like you're writing a check once a month and sending it in, and everybody's happy. That's traditional. That's historical. What has begun to take place, and with some lenders much more to an extreme, is where you may be required to have monthly, or even in some cases, real-time reporting requirements. The traditional has been more monthly reporting requirements, or quarterly or annual, whereby your lender will require you to submit maybe an audited financial statement of the property's performance every month, every 6 months, every year, whatever it might be. Any new leases that you engage in, they're required to effectively see those and potentially review those and sign off on them. Any major capital improvements must go through the lender and potentially be signed off on. But the whole idea behind this reporting requirement is to create basically an early warning system for the lender, okay? And that, for example, retail is a perfect example of this. You own a retail mall, and whenever you get the loan, you're full, everything is rosy, everything is working out extremely well, and then over the course of the next couple of years, you start to lose tenants, and the rent levels start to go down, and things aren't looking so rosy. Under the traditional model, the lender has no idea, because they're still continuing to do what? Get your mortgage payment every month. They're not really asking any questions, okay? They're just simply collecting that mortgage check and sort of moving forward. Whereas what has begun to take place with some lenders, more sophisticated lenders, is saying, all right, we want to see your rent rolls, we want to see your operating statements, either on a real-time basis or certainly, like I said, once a month or whatever. And they send them through kind of like an artificial intelligence sort of processing system to see oops, is there something that we, should be like danger, danger, we should be looking out for in the sense of you've lost tenants, your income is down, you may still be able to service your debt, but we're concerned as a lender that you may not be able to at some point in the future if the trend continues. So therefore, we want to be made aware of that. And this is the fun part. With that reporting requirement may come performance requirements. And if you fail to meet those performance requirements, your loan could be considered in default. Not actual default, but technical default. How would you describe the difference between technical default and actual default?
Technical default is just defaulting on maybe a term where financially everything's fine.
Right. The technical default is basically not meeting some sort of requirement, not meeting your reporting requirement, in other words, not submitting the paperwork to them in a timely fashion, or not meeting some performance, and I'm going to talk about that in a minute, but not meeting some sort of performance criteria that they set forward at the beginning of the loan. Therefore, they can hold you in technical default. Meaning, you're still making payments to them, the payments that you agreed to, but there's something that you're doing that they're not happy about, and therefore, they may have the option of coming in and exerting control over the property, even with a technical default. Does that make sense? Now, because most of us, we know what actual default is. Actual default is, I'm not making the payment anymore, or I'm not making the full payment anymore. As I said, historically, I'm trying to give you the perspective of this. Historically, lenders didn't care. Well, lenders didn't have the ability. Technology plays a big role in this. Lenders didn't have the ability to process all that kind of extra information. It wouldn't have been cost effective. And so, they were just very happy getting their monthly payment and effectively, just kind of keeping their eyes shut. And then, at some point, you as a borrower are not able to continue making those payments. And then it's not until then that their eyes became open and they're like, oh, wow, your retail center is 25% full. Yeah, I can see why you're not making your payments anymore. Now we're going to have to default, and potentially the property has declined to such a point that effectively the value is gone out of the actual asset itself to the point of where the lender may not be able to recover what they have loaned on the property. Does that make sense? So that is what I'm saying, that the lenders have become, many of them, have become much more proactive and saying, we want this information as kind of an early warning system. Now you as the borrower are saying, I don't want to give them all this stuff. Well, you may have that choice, but the choice is the interest rate. If you give them all that stuff, you may get a substantially lower interest rate than if you choose to go with a lender that doesn't require all that stuff. Do you follow what I'm getting at? And it's a trade-off. All of these are trade-offs. It's not, because you may be saying, I'm not going to, fork over all of my operating information, once a month. That's going to take me a lot of time and effort and energy and expense to keep up with all that sort of stuff. And, I don't want them having all that. Fine. You find a lender that doesn't require that, but chances are that lender is not going to give you the same rate as that one that requires that information. Does that make sense? Okay, that's part of what I'm trying to convey here. Okay. Now, on this, we're going to come back to reserve. On the performance requirements, what kind of things do you think a lender might place in kind of a performance sort of clause? Number one, must maintain a certain occupancy level. Whatever that is. 70%, 80%, come up with a number. Must maintain a certain debt coverage ratio, okay, which we haven't talked about yet in here. Obviously some of you are familiar with that, and that is basically the relationship between your net operating income that your property generates and the amount of the annual mortgage payment or debt service that you have on the property, okay? And saying that you, in other words, simply put, you need to have more than enough income coming in off this property to be able to service your loan, okay? If you don't, or you drop below a certain threshold, we're going to come in potentially and take over your property and manage it, or potentially have a forced sale, depending on how draconian or extreme these circumstances are. Okay. Now, as I said, these reporting requirements, can just be simply, all they want to know is what's your income, what are your expenses, what's your net operating income, and just to sort of see if there's anything out of the ordinary, and if there's not, you're not going to hear from them. If there is, you're probably going to hear from them. Okay? Yep.
Well, a lot of times, to circumvent this, landlords are requiring financials from their tenants as well, to get a picture.
Precisely.
Or making a picture.
Because at the end of the day, who's really paying the rent? The tenants. So what has happened, and once again, you're just like reading my mind here, but what has potentially begun to happen is more lenders are saying, I don't really even care about the borrower. What I care about are the leases that are in place on the property. Who are the tenants? How good of a credit quality tenant are they? And making the loan, to a certain extent, based off of the quality of the individual tenants, which gets into a whole other interesting dimension in all of this, which is whether you have office space or you have retail space and that sort of thing. Then imagine, once again, kind of on a theoretical level here for a second, this front table that you represent my different tenants that are in my property. Each of you obviously would have a different sort of risk profile, okay? That you may have an outstanding sort of credit score, background, that sort of thing. And so the lender, whenever they would evaluate you, would say, you're very low risk. We expect you to pay on time, every month, no issues, no problems whatsoever. So therefore, on that portion of the loan, that we may actually even carve it out to go to the extreme and say, we're going to offer a very low interest rate on this portion of the property, to even go to the extreme situation. Whereas Alyssa here is just an absolute no good, worthless tenant that has a horrible operating history and just absolutely horrendous credit score and that sort of thing. And we don't ever expect that we're going to get any money from her as a tenant. And so as a result, we're going to assess a very high sort of risk profile as the lender, and we're basically going to potentially charge a differential interest rate on her portion of the property. That's going to the extreme. But you sort of follow the mentality and the logic on this, is that it goes beyond the traditional analysis that we have become accustomed to, which is we're basing this just kind of generically on the property, generically on the market rents, generically on the property owner, all that sort of stuff, and drilling much deeper to the individual people who are actually occupying the space. That is the evolution of where we're going with this. And you're saying, well, that seems crazy. Why would, but yet, is it? It really isn't. It's just that historically, once again, we probably didn't have the technical or the technological infrastructure to allow for things like that. Now, much easier to get that, in other words, all that information can be submitted electronically and reviewed effectively, once again, kind of by artificial intelligence, kind of algorithms, and then ultimately at the end of the day we can say, yeah, all is good, or danger, danger, we need to kind of take a closer look at what's actually happening. Okay, make sense? Okay, any questions on that? Okay. One more here, and then we'll take a little break, 5-minute break, is on the reserve requirements. Lenders typically will require you to set aside either a certain percentage or a certain dollar amount, either upfront or over time. So in other words, you're not going to be able to take home all of your income that the property generates, even after expenses. The lender may say, we want to keep a certain dollar amount on reserve in our bank, may or may not be drawing interest, that's a whole other topic for discussion, but set aside in our bank, and the idea is that that money is meant to be set aside for and meant to be kept in there for unforeseen circumstances, or even foreseen situations of capital improvements. That we know you're going to have to replace the roof on your property at some point. We know you're going to replace the air conditioners at some point. We know you're going to have to, go in and do some retrofit, significant retrofit to the property at some point. We don't want you to be in a situation as a borrower, this is the lender speaking, we don't want you to be in a situation as the borrower where whenever those events occur, that you're having to come back to us again asking for more money to do those things. We want you to have the financial wherewithal to have the resources available to take care of those issues as they arise. Does that make sense? Now, what those reserve requirements are, how much they are, once again, totally dependent upon that lender. But here's the thing, does that indirectly impact your cost of borrowing? Yeah, because that's money that you're not being able to use for other things. You follow? If you're having to set aside, maybe a few thousand or a few $100,000, or in some cases a few $1 million, that's just basically sitting in a low interest bearing account, or maybe even in some cases not even interest bearing, just literally sitting there, you can be doing a lot of other things with that money. You could be investing in other projects, but instead it's stuck there in reserve. So when you really begin to kind of back it out and you really begin to analyze that, in one sense, it's almost like an additional down payment or an additional equity that you've got to sort of keep on reserve or have made available. Does that make sense? So definitely something, one more thing that one of the many questions that you need to be asking whenever you're sort of considering these loans. Okay, so let's do this. Let's go take a quick, once again, 5-minute break, and then we'll come back and then we're going to start getting into some of the calculations of some of these things. Okay?
Isn't that where they put like property taxes and all?
Yep. Same sort of thing. Yep. So once again, come back at 20 after. Okay, so let's just say that we've got a typical situation. One payment per year.
I just got back to work because they're really slow during college.
Shift. Anytime you see me this little black thing, that's one thing that's referring to that shift.
Help on vacation,
And in this case, clear all, which is the clear key there. And so then we would put in,
so isn't
so
it?
100,000.
Went up to the mountains and then saw my boyfriend's family in Savannah.
You just click that plus or minus button
It was
there.
good, and then got back to
It'll have a
work
minus
this week,
next to it.
so.
Yep.
So you more staying on the reporting zone?
Right now I am.
And
I
then you
mean,
click on CM.
Yep. In this case, we got 4 of those in a row. Final year is 100,
I mean,
over 10,000.
but I don't sell
You
for
don't, you
that.
don't, you don't want to.
I do stuff on the side for our family and friends, which is nice. Makes me some extra money. Just but I mean, I'm thinking what'll probably happen because right now I'm an intern.
So
It's partially
we're
my
gonna
joy.
so we'll be here, so we'll do that again.
But there's a position
So
that pays
100,000
better.
plus or minus
I will probably
cash
take
flow.
it as soon as I
What
graduate.
else is it? Cash flow.
It's to, I mean, it's not even a
Then
listed position, it's
10,000.
just a position that they like
And that
have,
occurs
but they're
4
like
times.
never
So 4
refilled kind of
shift.
thing.
Instantly right
It's
below
what I'm
cash
doing,
flow.
it's the office markets for Palm Beach and Broward County, doing all the reporting for that. It's my
Cash
boss's
flow.
whole job.
And
So
then
you, are
solve
you working
for
on coming up with
internal
a
return.
report that they send out, that they publish?
Gotcha.
Yeah, I mean, like, I did, like, what did I
Okay,
do
who's
this
next?
week? I did, like, the chart of the week this week, which, like, gets sent out, and then I'll do, like, the insight,
So
like,
I
I wrote
got
the
to say they're
CBD
going
meeting,
in for
like,
the
all the style, very, and
I
all
was
that,
not
and
gonna do it.
then after I got back from that, I did the CBD report.
100,000.
Yeah.
Plus or minus cash flow. Yes, that's the first one.
Yeah.
Otherwise, brokers, like, you know, permit paths, and then actually publish stuff like CoStar.
Well, like a lot of the stats we use, the people from CoStar, we have a
Oh, no,
stat
no,
sheet
no,
every
no.
quarter for every market. And that's like,
Yeah,
so
this
like
one
for the
is just-
example,
it's just the
like,
20
they say
by
this
itself.
building's
It's not-
included, this
in other
building's
words,
not, this building's class A, this building's
That should be
C, you know what I
20. This should
mean?
be
So, I mean, everyone's data is slightly different, but they're, mostly the same, but that's what we have
Okay, that's
for,
what's
like,
going on.
stats.
No, that's what it is.
Okay.
But implemented with that, if, there's a big
Yes,
difference
ma'am.
on
Good.
so we have to change that.
Now the requirements are not.
And then as far as the write-up, that's really based on what we're talking. Like in the meeting, it would be very.
Hold on, it should be, no, that last cash flow was 70,000,
Say
sorry,
certain
not
things, so like, I took notes on what they were saying, and I was like, okay, these are the things I wanna focus on.
Those were two different ones. The one that we did at the beginning of this was
Significantly, actually, it's a CD.
Look at
Same
any
problems with that market.
the initial cash flows were. Yeah.
I mean, long
Sorry about
term,
that.
I think
Okay.
what I would like to do is work with a developer on many sides of the project, and one of which would be, yes, being able to, I mean, I think when we company or have a team that I work with, then yes, I will have a decent market, background, but for me,
Okay, so
all
on this one,
our reporting.
okay, so one should have.
You know what I mean? Like, I don't care what
So we have 100,000. Plus or minus.
I think it's more gonna be done by what I think the value is, which yes, has a market.
Four times.
My idea
In subject, right below the cash flow.
like help decide what the best fit for a site would be, which is market, which is market. And that's what I would like to do. That's
You learn your force a lot,
what do you
but you don't really get that all.
next.
I know
A bunch of examples, trust me. I got one line as well. Yeah, I can point some, the focus really on the lecture and the book we're going to be using here is just for kind of support.
Yeah.
But there's
I'm
examples
in a
there.
good position because it's like.
You can, I mean, look up things if you need to, but otherwise, yeah, you don't have to.
This is not available online. I tried to
Right.
download it.
Right.
But I don't know something more than 5%. No, you're not.
Oh my God, you're crazy. He's talking about feathers.
Oh, yeah.
I know.
All and the architecture, which is, fun, so.
Like a Robin Hood helping finance.
The truth is, you're really good creative company, so you understand your name.
This, yeah. I mean, I did the investment class.
Okay.
I read a lot of this book already.
Oh, you
Let's
did?
get started.
Dr. Morgan, I got a question.
Yep.
What are current industry trends for mortgages? Is it cross-collateralization, or is it just
Everything. It once again, totally varies by the individual lenders. And my point is that lenders are becoming incredibly more sophisticated, requiring much more information from you as a borrower as a whole, drilling down to the tenant level sort of information and their performance, metrics. I mean, you can kind of like, for example, imagine that once again, assume that Mark is a Best Buy, as an example. So as a tenant, they've had some shaky things in the past, but yet, we hope that they've, have kind of done things in a way that's going to make them successful maybe for the next several years. But as a lender, we would want to know all loans that we have on properties with Best Buys in them, so that in the event that some sort of newsworthy event happens, and let's say Best Buy has said their sales are down significantly this year and don't expect to have that great of an outlook for the next couple of years, then as a lender, we are probably going to want to have, once again, more information as opposed to less information to sort of track that sort of thing. And what those lenders typically, they have these, believe it or not, they're called surveillance departments. And the whole idea behind those surveillance departments is literally on a day-to-day basis is to track a lot of that kind of information at the macro level and sort of say, for those particular tenants, where, once again, what is our exposure as a lender, on all these different loans, and to put out effectively some sort of like a watch report or whatever that kind of literally goes property by property or tenant by tenant and says, is this something we need to be concerned about or look into a little bit deeper?
Do you feel like the South Florida market in general has become more of a recourse market versus a non-recourse just because of what has happened?
Well, no, I think some of that, yes, but also they've required a lot more, down payment, as a result of the problems. And so, therefore, that's another way to mitigate your risk, is just to simply say, well, if we're not going to require all this other sort of stuff, then one way we can, mitigate our risk is, well, we require, instead of a 15, 20% down payment, we may require a 30, 40, 50% down payment. Well, then you hope that, your risk has been mitigated as a result of that. Because obviously under those circumstances, the borrower has a lot more skin in the game, and in the event of a default, they're going to hurt an awful lot themselves instead of trying to pass that on, to the lender. But, that's also yet another aspect of, some of these, more commercial mortgage-backed securities loans, is that was yet another benefit that, typically emerged, was that they required a lower down payment. So it was, once again, it was like the magical candy that, everybody wanted to have, because they're saying, oh, I can get a low down payment, I can get a low interest rate, I can, effectively, have a term that may even be locked into place for the next 15 years. What borrower does not want to hear that? But on the flip side, what, is not being said is, well, with that, you're going to have to provide us with monthly operating statements. You're going to have to be subject to a number of key performance metrics. In the event of you not meeting those metrics, we can claim technical default and potentially take control of your property in some way. We also are going to charge you this outrageous prepayment penalty in the event of a default on the loan, and we're going to have all these wonderful administrative fees that we're going to charge during the course of the loan.
Okay.
You see what I'm saying?
Mm-hmm.
And so, sometimes the best way to sort of teach and communicate some of these things is to kind of use the extremes and sort of say, okay, on the one hand we have a lender over here that doesn't require anything, have a higher interest rate, but then on the other end we have some of these that require all of these things, but yet there's trade-offs. That's the whole idea behind it. And you, as a prospective borrower, part of your job is to really go out there and to evaluate what are those trade-offs. Are those trade-offs acceptable for us and the kind of developer, investor that we are? Mark?
Do some lenders provide, like for instance with the reserve requirements, do they provide like you bundling that with the loan amount? If, let's say, if it's going to add value to the property, so the end value is higher, so they'll lend you more on it? Or is that not?
Indirectly, you can kind of achieve something like that. I mean, but as a general rule, it's sort of kept separate.
Right, so it's all extra equity
Right.
you could say into.
Right.
Okay.
Justin?
Do you think it's better to go to a bank that's gonna keep your loan on their books and their portfolio?
Excellent
Or
question.
go to a bank that?
Yeah, that's going to sell it off immediately? Yeah.
Get a better deal if they sell it probably, right?
Yeah, precisely. That's kind of where, going with all this. And that's yet another sort of story we can launch into it right now. And that is, historically, lenders kept the loans on their books. I mean, when I say historically, I mean many years ago. The idea was local bank makes you the loan, local bank keeps the loan internally, services the loan internally, collects your checks, notifies you in the event of default, forecloses on you in the event of default, all that sort of stuff. What obviously has happened over the past 20, 30 plus years is you have those lenders selling off the loans to investors that buy those loans that are just looking for a cash flow stream, but it frees up the money locally at that bank to make more loans, because the real place where the lenders make their money are off of the loan origination fees. Okay? And so the more loans they can make, the more money that they can generate, okay? Well, they could sell off the servicing rights to the loan. The servicers are the folks that actually collect your checks, process the checks, deposit the checks, remit the checks to whoever it needs to be remitted to, and they could sell off those rights separate and apart, and so maybe internally they didn't have to do it, but if the servicers would take that on, and at one point in time, that was an extremely lucrative business, because what the servicers could do, and this gets beyond our discussion right here for the moment, but what the servicers could do is they would collect, let's say, all these payments on the first of the month from all the borrowers. They would deposit millions, if not billions of dollars every single month, and have those on short-term securities, maybe to where they didn't have to remit the payment to whoever until the 15th or the 30th of the month. So they could effectively make a lot of money just off of the interest accrued off of holding that money very short term. One of the commercial servicers that I worked for as a consultant in Dallas for several years, Oryx Capital Markets, they, at the time, this is back in 99, 2000, they were processing on the order of about $50 billion worth of payments every single month. So they would have $50 billion of cash flowing into their accounts at the beginning of the month, and then would have to make the payments to the bondholders and the investors around the 15th of the month. But during that literally 2-week time horizon, they would get to earn the interest off of that. Okay? And the point being is that was one of the things that made those servicing rights so valuable, and that's how they would make money for effectively doing what they did. But taking away that responsibility from the primary lender. But your question about, well, the whole thing of selling off the loans, what the benefit there is, all right, my local bank may only have a $50 million lending limit, and once they reach that $50 million lending limit, they have no more money to lend. Therefore, they have to effectively sell off those loans that they've made to other investors, other banks, whoever, so that they can then, once again, make new loans and make the money off of the loan origination fees. Now, your question specifically was, is it better to have one versus the other? Yeah, I would argue if I'm a borrower, ideally, I probably want to continue to work with the folks that made my loan, as opposed to having to work with some third party that I've never met, and who knows what I've signed away in terms of my rights and privileges as a borrower when that effectively loan gets sold off to that third party. Does that answer your question?
Yeah.
Does any one of those provide a lower interest rate?
Well, no, what happens is, once again, that by virtue of doing that, indirectly, if you will, it could allow the primary lender, the one that actually makes you the loan, to actually offer you a lower interest rate, but yet they're getting their money off of the loan origination fees. And so that whenever they sell it in the secondary markets, well, they're selling it at maybe that lower interest rate, but that's okay. It's just that they're offering you up front a lower interest rate, because they're getting their money either way, but they're getting it off of the loan origination side. Okay? Other questions before we move into the calculations? Okay? Good? Okay. All right. So, let's start with the basics. Let's say, in this particular case, okay, first of all, now we're going to convert ourselves to monthly payments. Okay, up to this point we've been doing annual sort of payments. Now we're going to do monthly, since we're talking about mortgages, and mortgages have monthly payments, so let's convert ourselves over. So to do that, you're going to do 12, shift, payment per year, and then hit the shift and the clear all, clear everything out. And whenever you do that, when you hit that shift clear all, what should now pop up in your display is 12p year. Okay? If it doesn't, then you didn't do it correctly, okay? All right, so we start off, in this case, with our $100,000 loan, and this loan is going to be for 30 years, but it's going to be monthly payments, and so what we're going to do is we're going to put in as 30 shift in. Whenever you do this, you hit the shift in, what this is doing is, because it's on 12 payments per year, it is converting it now to monthly payments, and so it's going to show up in your display 360. In other words, 30 years times 12 months in a year, 360 total payments. Everybody follow that? So in other words, once you put this in, it should say 360. Okay? Then for the interest rate, we're going to put in 10%, and that's going to be our stated interest rate for the moment. And then we're going to solve for what is our payment amount, our monthly payment. And what you should get is negative $877.57 and some change. Okay? So let's see if everybody gets that. If you don't, tell me what you get.
What's that, 1/4R there?
Those interest per year. On the top row of the calculator has I divided by year. Interest per year.
Okay.
Okay, no solution means that once again, you, not sure what you did.
Something wrong.
Okay. Is everybody else getting though 877.57? Yes? Okay, what are you getting?
Negative 3,781.
Okay. Hit the shift and then the clear all, what does it say 12 per year or does it say 1 per year?
12 per year.
Okay. All right. Then probably what you make sure then when you put this in, you put 30 shift in to make sure you get 360.
I didn't do this.
Okay, that's fine. Yep.
Is that an N or NJ?
No, this is just an N. Okay, on the top, these are all, these,
I think that's who we get error.
okay, on the top row of your calculator, you have N, interest per year, PV, payment, and future value. Okay, on the top row of your calculator. So in this particular case, the N is there, present value, there, payment, there, interest rate, there.
With the N.
It's shift N though.
Shift N.
So that means
Shift, because,
EYR.
correct. So this, because we have it set on 12 payments per year, it is taking the 30, multiplying it by the 12 to give you 360 total in. Okay?
Can you just put 360 there?
You can. You can. But the only, and there's no reason not to. Just, you know, if you're comfortable with that, then I say go for it. But you know, like for example, if I were to say to you, okay, how many months are in a 15-year loan? Well, if you think about, okay, 180. You know, how many months are in a 10-year loan? Okay, 120. You know, and so it just keeps you from having to think about it in those terms. You're just able to put it in and it figures it out. Okay? Everybody good? Okay? All right. So, this is, once again, that's our monthly payment, okay, for that loan. Everybody good? Yes? All right. Now, what if we wanted to start off with figuring out what is our cost of borrowing if we have a 5% loan origination fee? Okay, how do we kind of have to think about that and in terms of when that occurs? Okay, how do loan origination fees work? Well, they are monies that you pay up front whenever you get the loan, correct? Okay. So, if you're paying a 5% loan origination fee on $100,000, how much is that going to be? $5 grand. Okay. So what's really happening there Okay, let's just kind of back up and think about the mechanics here just for a moment. Because this is the sort of logic that you need to get embedded in your head, okay? Because this makes things so much easier as we move forward. If you miss out on this logic, let me just sort of back up for just a second. All of these calculations, obviously, are being done with a calculator, going to be done with Excel, that sort of thing. But you need to understand the logic, okay, behind them. Punching the buttons either on the computer or on the calculator, that's all fine, but you need to understand what are the variables that you need, what you're doing to potentially manipulate them, and what the resulting impact sort of should be. You need to understand that. I mean, I'm not teaching you math. I'm teaching you, once again, or what should be, logic, okay? So even if you're bad at math, you're bad with numbers, you still, if you're a logical person, you should be able to sort of pick this stuff up and you know, through a little bit of practice, and it will all make sense, okay? So, $5,000, let's say, loan origination fee. So what is actually happening there? Well, in one sense, they're only really loaning you $95,000. Does everybody sort of see that? Yes or no? But in other words, here's what's happening. I go to the bank, I get this loan, they effectively cut me a check, let's say, hypothetically, for $100,000 to buy the asset that I want to buy, correct? I then in turn, simultaneously, am writing them a check for $5,000 that they're now depositing, correct? So, as Robert was saying, in effect, you're really only getting a $95,000 loan, but you're still having to pay back $100,000. Does everybody follow that? Yes or no? That's the logic part that I'm talking about.
Okay.
Okay? So, if that is indeed the case, that you're really only getting $95,000, but you're still having to make payments as if it were $100,000, what we can do is we can put this in as our new loan amount. After we have done all of this, we're going to keep our payment constant, because we're still going to have to pay back the full $100,000, correct? And we're going to keep our term constant, because we're still paying back over 30 years. But what's really going to be changing here is our cost of borrowing. Because and this is the logic part that I'm trying to get you to hone in on. Without doing the calculation that we're about to do, you should be able to intuitively begin to say to yourself, if I'm only getting really $95,000 up front, but yet I'm paying back as if it were $100,000, then my interest rate or my real cost of borrowing is going to be something greater than 10%.
Right.
That's the logic you should be beginning to kind of grab onto. Okay? Now, do we know precisely what that percentage difference is? Not without calculating it, but we should know logically it should mean we have a higher cost of borrowing. Now, to find out what that amount is, all we've got to do is one little step. We basically solve for the interest rate, which we've already put that information in. Think of this, it's kind of like this is already set up in the calculator as a set of formulas of inputs and variables, and all we're doing is kind of replacing, okay? So in other words, we put in all of these key inputs, we make this calculation that the calculator solves for us, but now we're replacing the actual present value with this, but we're keeping this held constant, but we want to see what the impact is on our interest rate or our cost of borrowing. So what we should see is this number is something greater than 10%. So let's just see.
You have to change the PV first.
Yeah, you got to put in the 95,000 as your PV. You just follow through the keystrokes as I've got them there. And what you should end up with is 10.62%. So what that's saying is because that loan origination fee of $5,000 the impact of that over the course of the loan is that instead of really paying 10% as our interest rate on this loan, we're really paying 10.62%. Does that make sense, yes or no? Because we're only really getting 95,000. Okay? Okay, have I blown you away yet, or are you still on the cloud? Okay, okay? All right. Now, what else could we do to potentially inflate that return as a lender? What do we say we could do? We can charge fees, like ongoing fees, like administrative fees, so that like every month that they process your payment, they charge you 50 bucks. Okay? How would we deal with that? Well, how we would deal with that is that basically now we would go in and we would change our payment amount, so it would no longer be $877.57, it would be $877.57 plus 50 bucks. Okay? So let's do it. $877.57 plus 50 bucks would be $927.57, and then we would put that in as a negative, since that's a cash outflow to us. In other words, just like it came back as a negative here, since that's a cash outflow from our perspective, we've got to put it in as a cash outflow from our perspective as the borrower, as our new loan amount. I'm sorry, payment amount. Payment amount. New payment amount, and then we can just drop down right below that, resolve again for the impact that that has on us. Now we're up to 11.32%. Now we're not putting in everything all over again. We're just continuing where we left off.
Oh, I'm cleared now.
Yeah, no. Unless I tell you to clear, don't clear.
Okay.
You know, we're starting up there. We're working our way down. Okay.
So you can just re-plug it in?
That's the idea. You're just plugging it. You're just.
Oh,
I understand that.
Okay.
Yeah.
That's why I'm trying to. Yeah. Listen.
So that means that in the new formula is using 95,000 as the
Correct.
present value.
Correct.
Okay, that's what-
Correct. In other words, we made this change, and now we're making another change. So we made two changes. And already we've seen our 10% rate jump up to 11.32%. Is that right with me?
Right. At the end, you're trying to really figure out what's your real cost.
What's your real cost of borrowing? Okay? Kathy, you okay over there? Okay. That's one.
So after the minus 877.57, what would be the next step? 95?
Yeah, the next input on the calculator would just simply, well, I mean, you actually go ahead and input just like I've got it here, and whenever you get the 95,000, you just put in as present value.
Okay.
Or you can bypass, obviously, that minus that and just put in the 95,000.
Okay.
If you can, you know, once again, if we can do that math in our head, then we don't have to put that in. So, okay. And the same thing down here. You can, obviously, if you can do the math in your head of 877.57 plus 50 bucks, then all you have to do is just put in the 927.57 plus minus payment. Okay? Okay. All right. Well, let's continue. Okay? Now, let's say we're going to deal with a prepayment penalty. Okay? We'll start fresh on this one. Because we're going to combine all this together. Okay? And this is where it begins to start getting really, you know, hairy at some point, because you're going to have to stay on the logic train. If you get kicked off the logic train, it all totally just goes crazy. Okay? Got to stay on the logic train. All right.
Clear all.
Clear all.
Sure.
Okay. 12 payments per year. All right. We start out with our $100,000 loan. Whoops. Not 1 million, but 100,000. Okay. And we're going to keep it at the 10%. for 30 years. Go ahead and get our monthly payment of the $877.57 again. Okay, all right. So that's nothing new. That's just kind of putting it in again, just to do it fresh. Okay, so now the situation is going to be we're going to have a prepayment penalty. Okay, and the terms of prepayment penalty are going to be as follows. Prepayment penalty of 5% of outstanding mortgage balance if paid off before end of term. Okay? Well, what's the end of term here? 30 years. So if you pay off this loan early, in this particular instance, before the end of that 30 years, you're going to be subjected to this prepayment penalty of 5% of whatever the outstanding mortgage balance is. Does that make sense conceptually to everybody? Yes or no?
Yes.
Now, normally, the prepayment penalty is, you know, it maybe is attached to the term. Normally, it's not quite so egregious as to say, okay, you have to pay off, you know, over 30 years. Normally, it's more of the situation if it's paid off within the first 5 years or something like that. Normally.
Right.
Okay, and so most loans are going to say, well, yeah, if you pay it off before the end of the 5th year, then we're going to charge you this prepayment penalty, or there may be a sliding scale. If you pay it off within the first 5 years, it's 5%. Within the next 5 years, it's 4%. Within the next 5 years, it's 3%. And you know, you can come up with a gazillion different iterations of how this thing may be put into place. The point that you need to focus on, though, is that you're, in this particular instance, you're going to be charged a penalty for paying off this early. Now, so let us say we want to pay this loan off at the end of the 5th year, okay? So we are paying off loan at end of year 5 or month number 60. Everybody understand that? 5 years times 12 months equals 60 months. Yes? Okay. All right. So what we need to do is we need to find the balance of the loan at the end of 5 years or at the end of 60 months. So what we do, our calculator, once again, will do all this wonderful work for us. We simply say, I'm going to explain all this in a second, input 60, shift, amortize, equal. Okay? Now, let me explain what you're doing here. The calculator keeps all this stuff in memory, and it effectively has already built an amortization schedule in its memory of effectively every single month. It has already calculated how much principal is being paid on the loan, how much interest is being paid on the loan, how much of the loan is remaining for each of the 360 months. We are wanting to access that information, and so the information that we are specifically asking to access is, tell me the principal, interest, and more specifically, the outstanding balance of the loan from month number 1, or period number 1, through period number 60, and then shift amortize to access that amortization schedule, and then it's going to give you the interest, principal, and balance, okay? Boom, boom, boom. Now
is it always months on this calculator?
that is based upon what you have done up here.
Gotcha.
If you want to make it annual, you have to
stop.
Absolutely. Okay, so now let's do this real quick. Okay, the first number that it gives you is the principal, 34,25,68 rounded. Hit equal again. It gives you the interest portion that you've paid during that time, which makes you disgustingly sick, of 49,228.61. And then you get your balance at the end of year 5, or in the month 60, of 96,574. Oops. $574.32. So it's exceedingly disgusting whenever you realize that over the first 5 years you have only paid down $3,400 worth of principal off of this loan. You paid $49,000 in interest, and you still owe 96 grand. That's just disturbing and disgusting. Because with 30-year loans, the majority of what you're paying at the beginning of the loan is interest, and it's only as the balance of the loan begins to drop that you effectively are paying more in principal. Okay, so
negotiate though, correct?
Well, I'm sorry?
What you want, sometimes it can be negotiated, what you want paying principal and interest.
Yes, no, you can actually, and we're going to talk about this, we can have constant amortization mortgages, we can have constant payment mortgages, we can have constant interest or interest-only mortgages. Yeah, so there's a lot of other ways, but the standard, normal, traditional, fully amortizing mortgage, this is it, okay? Now, okay, so this is our balance at the end of that 5-year period. So what we're saying is that balance we're going to multiply by 5% because of that prepayment penalty. Okay, so let's do that first. So 48.28 is going to be our penalty that's going to be assessed to us at the end of that. Now, does anybody see it even a more disturbing thing? That penalty is greater than the actual principal that we have paid off over the course of the loan. It actually puts us into effectively a negative situation so that we actually owe more on the property than what we paid for it. Okay? Did everybody see that? Yes or no?
Yep.
I have a question. You know how you were saying that you could kind of choose what you want to do for the interest? Or
Well, okay, no, there are, okay, what you can do, and we're going to get into this, but you can have what is, this is referred to as a constant payment mortgage, which is a normal, fully amortizing mortgage. This is, 90+% probably of all mortgages are going to kind of fall into this sort of category. The lesser type of categories are going to be what are like interest-only loans, whereby you don't pay any principal, you just pay the interest every single month. It'll be a lower payment, but yet you never pay down your principal. Or you can have what is called a constant amortizing mortgage, which is where you pay off a fixed amount of principal every single month, which means that you, up front, you're going to have a much larger mortgage payment, but over time, it will decline. But most people want a fixed payment internally. Don't misinterpret what I'm about to say. Most people want a fixed payment for their mortgage as a general rule. Now, that having been said, we can have variable rate mortgages, which make up a very significant part of the residential market, not so much in the commercial market. There are variable rate mortgages in the commercial market, but traditionally what has been done in the commercial market is to adjust for interest rate fluctuations. That's why you only have the terms of like 5 years, and then it readjusts at the end of that 5-year term. But that having been said, does not preclude a lender from saying, we are going to give you a variable rate construction loan or variable rate commercial loan. It's just that they're few and far between.
Just to get a quick understanding of the functioning of this calculator, I have my $4,800 up on the screen right now. If I were to hit say PV by accident right now.
Right.
Would that change?
It would replace the PV with this.
So if I want to keep everything constant from here, I hit clear now?
Right.
Not clear all, but
Not clear all, just clear. Clear by itself, the C key by itself clears only what is in the display. The shift, clear all, clears everything out of the memory registers. Okay? So that's, you know, so the clear is just like if you make a mistake, you type in something wrong, well, you can, but there's also one of the cool things on this calculator is also as a backspace key.
Yeah.
Okay, so that if you do start to type in a number wrong, you can backspace it out. Okay.
So if you, so you can clear there and change, like, go back and change like your interest rate?
Yes.
And then come back to what your penalty will be?
Right.
Okay.
But from here, you don't want to hit PV to go look at what the PV was, because then you're changing the PV.
Correct.
Okay.
Okay, so, okay, there was one more question. Yeah.
What does that one stand for?
Which one over here?
For the input, yeah.
This is just simply saying we're starting with period or month 1 to go through period 60. Now, see, here's and I'm glad you brought that up. We could have put in, because of the information that we're seeking, we're just seeking the balance. We don't really care about the principal and interest. I mean, in the sense of, for the calculation of what we're doing. We could have put in 60, input 60, and then what that would have done is only give us the principal and interest for that 60th month, but our balance would still be the same. Okay, does that make sense?
Yeah.
Thinking of it in sort of spreadsheet terms, which we're going to be getting into, you know, this is just simply saying add up the entire column of principal, add up the entire column of interest, and then show us, you know, what the balance is. Whereas if we put in 60, input 60, it would be giving us that one singular line of interest, principal, and so forth for that 1 month. And you could also do it for, like, if you wanted, I mean, just sort of throwing this out, if you wanted to do it just for the 5th year, then you could do 49 input 60, which would be year 5. Month 49 through 60. Okay? Yeah, there's all kinds of cool things you can do with this. Okay? And there's also an app on your, if you've got an iPhone, you actually can get a HP10B app, which I use all the time. I absolutely love it. So it used to be the case. What, I'm sorry?
Oh, you said it's an app.
Yeah, you can get it as an app on your iPhone. And it's great for being on the run whenever you don't carry your calculator. I mean, whenever, you know, I was much younger and a geek, I would carry this calculator with me everywhere I went, you know, but now with iPhone you don't need to, you know, have to.
Yeah, only if.
Okay, now we move on. All right, so our penalty. So what we need to do is we need to adjust our balance to reflect this penalty. So what's really happening here is at the end of the 60 months, we are having to pay off our balance plus that penalty, correct? Okay, so here's what we're going to do. We're going to put in the $96,574.32 plus the $48,28.72. I'm going to kind of try to draw some lines around this so it's all mixed up. And we're going to hit equal to get the total, okay, these two added together. Or if you like the shortcut, you can just, whenever you calculate your balance, you can just do what? Multiply this by 1.05, and then it will take care of all that and add it together, but don't worry about that, just go ahead and do it this way. Okay, 48.28, 2 plus. Okay, so our total payoff is going to be 101,403.04. Everybody good with that? Okay. Now, what you're going to do is we're going to put that number in as our future value. In other words, this is our payoff amount. So we're going to put this number in, and since it is a payoff amount, is that a cash inflow or outflow to us as the borrower? Outflow. In other words, we're writing a check to the lender for that amount, correct?
Right.
Now, this is one of the things with the calculator and with Excel, same thing. You've got to keep inflows and outflows, you know, sort of, you know, clear in your head in terms of the logic. Whenever you're borrowing, this $877.57 is a cash outflow to you as the borrower, correct? You're writing a check to the lender for that amount. When you pay off this loan with the penalty, this is going to be an outflow to you. So you're going to change the sign, and you're going to put that in as your future value. Okay, which is the kind of the top upper right-hand corner of the calculator, future value. All right? Now, all we have to do to solve for our effective cost of borrowing, two more little steps. And don't get ahead of yourselves, because your inclination now is, oh, let's just push the interest rate key and we're done. No. What we've got to do is we've got to convey to the calculator that we are just going to be looking to the payoff occurring at month 60. So what we've got to do is put in 60, or we can put in 5 shift in as our new term, our revised term, because our term is no longer 30 years. It's now 60 months or 5 shift in or 5 years. And now we can solve for the effective cost of borrowing. What?
10.7.
That sounds about right, but I'm going to go ahead and double check. I don't trust anybody, including myself.
Is it 60 shift in?
No, just 60 in.
Oh, I think
That sounds like that would probably be right. I'm going to put it in myself just to make sure. Trust no one. Okay. Yep, 10.74. Okay, so just based on the 5% prepayment penalty, without all that other stuff we've already had messed with in terms of loan origination fee and whatever, just with the prepayment penalty, we're already up to a 10.74. Okay, so I see that? Yes or no?
Yeah.
Now, once again, here's another logic thing for you to think through. If I were to effectively pay off this loan even sooner, what would happen? Will this be higher or lower?
Higher.
Higher. Okay? Because think about it. It could be as extreme as I get the loan today, I pay it off tomorrow, and literally I'm going to be assessed, you know, and in that sense, none of the balance has been paid down. You know, it's like $5,000 extra penalty, you know, so $5 grand just poof, gone just for prepaying the loan early, kind of thing. Make sense? Okay, are we good? It's time for another quick break. Yeah, let's take another 5-minute break. Okay, I know this gets we're getting to the point where we're gonna start tailoring off and get a little bit more conceptual. So that's why I try to do all this heavy stuff in the morning, and then, like I said, next week or next time you see me, we'll do even heavier stuff in the morning. But I want to try it so the afternoon will be a little bit more relaxing. That's what I'm trying to say. Okay.
Time's lunch.
I hope they don't do that.
We'll talk about that.
Food is a priority.
Oh, no, you definitely want 12. 12 is very close location. Totally different sort of way of interacting.
So 10, BB2.
Yep.
Now with this size,
Sushi Saturdays. Yesterday I went for
Well, the app is okay, but I wouldn't recommend, just like for the purposes of the test and that sort of thing. I would just, if you want to, just borrow one of mine.
Okay, all right.
I have no idea.
Oh, no?
No, I know nothing about student loans.
I was like, I don't know if you would know.
I'm not even gonna be in town for that, the big, like, ceremony, like,
And we're starting back at 10 after, so you got about 4 minutes left.
You guys get like the leftovers?
Yeah, we
Yeah.
Eight nights a month. 12 nights of partying.
There's like 12 candles, right?
There's 8 and the one that lights. So by the first night there are 2, the one that lights the candle.
Okay. So what do you do for presents? You get a present every day?
Over the age of 18, right?
Oh, yeah.
I can come over from here.
But is that what they normally do?
Yeah, me and my niece go up.
Do you guys do the free candy? You do free candy? You do free candy? Are you Catholic? That was like a big thing. That was like a big thing of mine.
Yeah,
My wife's family.
I think, yeah, but I don't think that's fair. You do whatever.
The only thing that's different is,
Yes, that's why I don't do like,
yeah, I mean, I think it's something good.
other than that.
You don't believe in Jesus Christ?
I didn't say that. I believe Michael Jordan is.
No, we believe that.
I say good.
Yeah. And that Jesus is just like a normal dude,
Yeah.
right? Or that he could have been, but.
We made him something. It's a.
I mean,
What? That's like, I mean,
Why can't you do what man?
there's a lot of girls that claim that.
Like that show.
They're like,
Virgin, what's the name? That show.
that reality TV.
No, it wasn't reality, but anyway, long story short, by the end of the show, she turned out she wasn't a virgin.
She's like, I'm pregnant, reborn.
Yeah, oh.
or it's like,
I want to go get some.
it's like,
I know,
Jerry
I wonder
Springer.
what time it is.
Do they have tuna, body tuna stuff there? Is it like good? Is it the thin thing? Or is
I
it?
get the tuna and taco now.
Yeah, that's thin though, right?
Yeah,
It's like
thin, it
paper.
has like
Yeah.
a soy sauce.
I know, but it's like a paper
condiment.
thin.
No, it's not that thin.
I want like, I want like, I want,
Yeah.
Without the rice.
I want like ahi tuna with some like.
Like bonefish.
We should
I
call
like
it.
your outfit, you all greened out today.
Christmas Eve.
There we go.
Get the red on. Any vacation from vacation?
You do anything? Go away.
No, yeah, lots, my son's, my oldest is 6, so he's like really into Christmas.
It's like, this is his.
This is a big water now.
Yeah.
What's the fad for a 6-year-old now?
Well, it's just like the whole Santa Claus.
Yeah, well, toys wise.
Yeah, he won this like thing with like a logo diamond.
Gadget.
I don't know, he was the only one that won, yeah,
That's
Legos.
just the surface.
Legos are kind of big right now.
There's always like.
Well, I am too. This is the only thing I own that is just.
Nino.
Doctor.
Before you had a question.
Yep.